All right, guys, we're in Huntsville, Alabama with Evan McCuen, and we've got this, Evan, we've got this 24-unit building behind us. I'd love for you to kind of tell me a little bit about it.
Yeah, so we purchased this in August of 2022. So we bought it for $1.25 million. We actually bought it seller financing, put $250,000 down. We did a syndication on it. And then the seller carried back the note for $1 million at 4% interest.
Okay.
So that's how we acquired it.
Wow.
We've been in the process of doing renovations in phases. And so we're at our last phase now. We're going to view 3 or 4 of the ones that are just about done.
Okay.
And the building's probably about 50% occupied.
Okay.
We've got 5 vacancies right now. And we've spent, our total raise, I want to say, is like $600,000.
Mm-hmm.
And so we're spending about $15,000 per unit to renovate, not including furniture. So 5 of these are Airbnbs that we short-term. And so we're doing a mixed model. So we do STR with MTR and long-term. But I'm leaning more towards MTR right now.
The midterm.
The midterm, yeah.
Okay,
MTR
which means what, like a month at a time?
A month, 2 months at a time.
Okay.
So that could be like traveling government contractors, traveling nurses. It also could be, construction workers, anybody that's going to be here for a month or 2 months and they just need a fully furnished unit.
And I'm going to dig a little bit deeper into the numbers if you don't mind here in a minute. But I want to ask you specifically. So the first thing I see when we pulled up is there's a barber shop.
Yes.
There's like a business.
There is a business here.
So it's kind of, tell us where we are. I know we're in Huntsville, but kind of direct us where we are and why this is possible to have a business while also kind of residential.
So it's about an acre of land, and so we're pretty close to where they're doing all the new construction, like Campus 805, Stove House. So we're like 2 or 3 minutes away from there. They're doing a bunch of development. This is an opportunity zone, but this property is zoned commercial. So since it's zoned commercial, you can lease to businesses, you can lease to midterms, short term. You can kind of do whatever because it's zoned commercial. And so that was what attracted us to this property, is because it's zoned C1, which gives us so much flexibility.
So, but what does that mean to the tenants? You have people who live here long term,
right?
With a business, people kind of filing in and out of this business. Is that the only business?
So there is 2 businesses. So I've got an Herbalife lady in 5, and then the barber shop. The only complaints that I get are unit 6 and 7, or 7 and 8 right here, because of all the foot traffic. But we've put up like security cameras and measures to like help deter that. But ultimately, he's one of our best paying tenants.
Right.
And so I don't want to like just push him out because he owns a business.
Sure.
I don't think that's fair to him.
Sure.
And we inherited him. So like when we took possession of this property, I think it was like 20 units, and I think 4 were vacant. And we got rid of 75% of the people. Because? Either non-payment, lack of, they weren't taking care of the unit, behind on payments. We just weren't renewing leases for anybody. And he was one of the ones that, he came to me, he's like, I want to stay, I want to, grow with you type thing. So actually he's got first line to dib that office space over there. So he's going to move his business over here. So the
24 unit also comes with an office space,
yes,
which is this smaller building that's right here.
And we leased that out too.
And so that's leased out separately.
That's leased out separately.
Okay.
Yeah.
All right. Well, Evan, I got a million more questions. So let's get it out of the sun.
Yeah.
And let's take a look at a couple of units here. You said you're working on a couple.
Yeah. So we're working on a few in the backside.
Okay.
Units 9, 10, and 11. We've renovated all but 3 up front. And so these are the last 3 in the back. We've built a privacy fence here. So we had trouble with people breaking in back here. We had trouble with homeless individuals. And so we had to cut down all this landscaping and build this privacy fence. And we put up some cameras to help, we really want to upgrade this building. And so since it's a slower turn, a slower process, you can't have people breaking in and calling the police, and it doesn't make tenants, very good when you've got the police here all the time.
For sure.
So yeah, let's walk into one of the units. Let's see what they got going on. This is unit 9. So as you can see, they're still working on it, but we've got new LVP floor, new door, fresh paint. Looks like we're about to be installing the cabinets here soon. We pulled owner's permits on all these, and so we just work with the city. So our plumbers and electricians, they just pull permits under our owner's permit. And then we're going in with new HVAC.
So you don't have to be a home builder?
No.
To do it under an owner's permit?
Mm-mm.
Interesting.
No.
Because you own it, but you're not living in it.
I'm not living in it. I don't plan to sell it within the first 12 months. So you can pull an owner's permit on even residential properties. They just don't want you to sell the house in Huntsville city limits within 12 months. So what they're trying to deter is a lot of the flippers that are fly-by-night flippers, not the people that don't want to do it right type thing.
Otherwise, if you did sell it within the first 12 months, you would have to have a home builder's license.
You would have to. Like if you plan to sell, or you would just hire a contractor,
sure,
general home builder,
sure,
and have them pull the permits and just let them do that. Which is, I mean, that's what we do too.
Right.
So yeah, but yeah. So in here, what we do, we just do new vanities, new light fixtures. We kept this tub because it was actually good condition, and we just restained it. So we reglazed it. So yeah, so this one's work in progress. Looks like they've just finished painting the.
So hold on, what did I miss here? What? This is the whole unit?
This is the whole unit.
Oh wow!
So yeah.
So there's the bathroom. What did I miss? This is the
kitchen area. So this is the kitchen area.
Gosh.
So you got the water heater. You've got a set of cabinets, and then the refrigerator will go there. But you do have a nice walk-in closet. And so this is where the bed will go.
Wow. Okay.
Yeah.
So is this you said earlier you're leaning more towards the midterm rentals. Is this kind of something, because this is kind of set up like a I don't want to say a hotel, but like one of those long-term stay hotel, extended stay type of hotels.
It's kind of like that.
It's kind of set up like that.
It is set up like that. So these were built in '85, and so I think when they first built these, it was multi-purpose. I mean, for the zoning, and so they leased offices. So actually, a lot of these were businesses, and some of them were long-term tenants. So like they made the space all the same, but then they would set up different spots so you could work out of these. So that's why it's called Courtyard South, is because there was a lot of different businesses that operated out of here.
Interesting.
So like office space.
So this will, you prefer the midterm rental. This is for probably a working class, somebody who's traveling, a traveling nurse, something like that.
Yes.
Come in and just have a place to stay. So you're going to furnish it and do all those things.
Yeah, so these back here, I'll probably put long-term tenants back here because they want more seclusion from the front.
Okay.
The MTRs in the short term are going to be up front in the courtyard because there is more flow and walk through.
Okay.
But I want the long-term in the back just because they have their own privacy.
Gotcha. So who is going to rent it long-term? Like, what's the tenant like? Like, what's that avatar look like?
It's a blue class worker. You know, a lot of times it can be nurses still. There's a lot of tenants that I work that have come to us, and maybe they're single mothers or single parents. Maybe it's husband and wife couple. So since they are secluded, like they're little units. I mean, you don't want to get more than 3 people in here living long term. Our turnover rate is about every 2 years, 2 to 3 years. But I have some that want to continue to stay here. I mean, we get $975 out of these.
I was just about to ask you that.
Yeah.
So $975 for a studio, basically.
Yeah. Now we'll pay up to $75 of utilities, and then we have Google Fiber ran to each unit, so they can get their own internet for like $75.
Wow. Okay.
Yeah. So $975. Now, when we took over possession, they were at like $450 to $550.
Right.
And that was pretty rough.
Yeah.
Yeah. So he used to lease to Wellstone. And so a Wellstone is a facility that helps mentally unstable individuals.
Okay.
And so he did that, and then people on welfare and stuff like that. And so they couldn't really afford to be in a place. Even when rents were so low, they couldn't really afford to be in a place because like they're collecting $650 checks and they're giving it all to rent.
Right.
That's not something that we look for, right? So our avatar is somebody that makes at least 25, 30K a year, maybe a little bit more, dual income. This is a temporary place for them. It's not a long-term, like 10, 15 years type thing. We want to be like a stepping stone. I want to potentially help them get into a home, right? Maybe we can sell them a home, or maybe we can sell or finance them a home or something like that. So that's the way I want to treat this, is to help people, in situations. Right. Maybe they're trying to get out of a situation, or maybe they're trying to better themselves type thing.
What did this look like before? I can smell the paint. Yeah. Obviously, you got new everything's going in.
Yes.
So what was it like before?
Let's go.
Do we have a before picture? I meant like a before unit.
I have a before unit up front, so we'll have to walk up there. Let's see what they got going on over here real quick.
Cool.
Do you want to see a finished one real quick?
Yeah, let's go.
All right, let's go see a finished one. He's not done with that one. So we're gonna walk the back side of the building. We're gonna go into unit 12 on the back side. And
so how many are we working on right now?
So we're working on 3. 3 back here, or 2 right back here, 1 right here, and then 1 up front. So total of 4.
And there's how many occupied?
So there is 12 occupied.
Okay. And then of the ones that you're not speaking of, so 12 plus 4 is only 16. So of the remaining 8, they're short-term rentals.
So six are short-term rentals, and then I've got 8 back here that are vacant.
8 that are vacant back here.
8, yeah. So 4 over here and 4 over there.
Okay.
And then there's 4 vacant up front. So that is
you have 12 vacant.
Yeah. So it's half occupied.
Wow. Okay.
And so half of them.
Why? So what? Tell me why 12 are vacant? Because you've had this for a few years.
Yeah. So we just finished up these 5 over here. So we just finished these 3. I've turned them over to management, and so it's a little bit slower for the market rate right now. So actually, it's taking longer to lease a house than it is to actually sell a house right now. Average days on market in our area is like 50 to 70 days to sell a house or go under contract, but the average days on market to lease a unit is like 3 or 4 months because there's just so much inventory.
Really? There's so much inventory. So we're in Huntsville, and I'm hearing the exact opposite. I'm hearing housing is scarce, and there's nowhere to move, and
there's plenty of inventory out there. Yeah, there's plenty of inventory. So there's if you were to look up and see how many properties are being rented, there's a lot.
No, Evan, are the rents too high?
They could be too high. Maybe not for us, but there could be other places that are too high. I want to say that we're on par, and it's really finding we've had applicants, but they're not qualified applicants, so they've got to meet a certain income to be able to hit that 975.
Yeah. Now, is this a situation, Evan, where you're like, I don't want these to be vacant for this long, so we need to drop this rental rate so we can, or you want to kind of hold firm?
I'm going to hold firm right now, right? I would say we're going to get our price. The building's already been appraised for 2.5, stabilized.
Okay.
And as is value, it's appraised at 1.9.
So, but the valuation, you said 2.5. So the valuation 2.5 is based on the rents that
at
you're projecting.
Exactly.
Gotcha.
Right.
Okay.
And then 1.9 as is.
Gotcha.
So now we're going to hold firm. I might consider lowering our standard to a potential applicant, but we're still gonna get our price.
Wow. That sounds risky to me, man. You're gonna lower your standard.
Well, what I mean by that is
explain.
There's a lot of families out here that need a place to go.
Right.
And so maybe they've had an eviction recently. Maybe it's a single mom. Maybe it's a single dad. Maybe it's maybe it's a family that they don't have a place to go. And so normally I would not look to, fill our units with that, but at some point we can still help them and explain hey, this is what the rent is. You can meet a certain type of income, but they don't have great credit, right? I'll be honest, I don't care about credit to an extent. I care about, bankruptcies. I care about previous evictions, lawsuits, stuff like that. But if they just don't have great credit, but they have the income, I'll lower my standard to those individuals and help them out, because we can help build their credit back up.
But you just got done saying, and I think this is why people like watch my channel, because I'm not afraid to ask the questions. You just got done saying that an eviction.
I would consider that. Considering it is one thing, but actually doing it is another.
Okay.
Yeah. I mean, everybody has their own story.
Totally true. I totally believe that.
Yeah. And you have a standard.
I've talked to enough people, and I'm not saying you're right or wrong.
Yeah.
I'm just saying I've talked to enough people to where the consensus that I've heard from, again, this has nothing to do with you and what you're doing, but I've heard that I'd rather take less money and get the right qualified person in. That way, I mean, how long does it take to evict somebody? In
about 6 weeks. 6 weeks.
You can get somebody out in 6 weeks?
No. You can't get somebody out in 6 weeks.
How long would it take to get somebody out?
I would say about from the time they quit paying or the time that you file eviction.
From the time they quit paying.
It would probably take about 3 months, three to 4 months. Right. Sometimes I've got one in Decatur that they quit paying in March or April, and my court date's not till September. Yeah. And they're supposed to be paying $2,000 a month in lease payments. And so that one is an anomaly, but there's other stuff going on.
Right.
But usually, I've only had to evict 3 people out of this apartment complex.
Okay.
Either they will not renew lease, or I'll do cash-for-keys.
Gotcha. For sure.
Yeah.
All right, so we've got, now tell me about this unit. This is pretty much similar.
This is all similar, yeah. So we've got one, we just need to get this painted. So this one's done. Everything looks identical.
So we got some shelves, a couple cabinets. We've got some base cabinets. Everything's new.
Yes, yeah.
Small refrigerator. What's going here? A dishwasher, possibly? No, stove.
Stove's going to go there, so we get the 20-inch stove.
It's a small stove,
yeah.
But at least it's a stove.
It is a stove. Brand new units. You got the walk-in closets. Pretty much everything's the same.
Same thing over here. So we've got this space right here for a bed, and we've got a bathroom, and then we got this walk-in closet.
Yeah, there should be a light over there.
And it's really well done. So your LVP, we've got a small sink, bathroom. Everything's done nice.
Yeah.
This is not done cheaply. This is done well.
Right.
So $975.
$975.
Gotcha. Okay.
Now I've even also I've heard of other people in this market say, I'll take a chance with them. They'll lower their standards, but they're going to want first month's, last month's rent and a deposit. So they're charging them more up front to get in. So there is that. But I'm also seeing like Buena Vista right over here. They're giving 2 or 3 months free just to get people in the door. So to your point, it just depends on the building, what they're doing, and their strategy. Because there is different strategies.
Sure.
Yeah.
Sure, for sure.
Yeah.
I thank you for taking me through that.
No, you're good.
I don't mean to push back.
No, you're good. You're good.
I want to ask the question.
As much as we've put into the building, I think if somebody's paying more, they're going to appreciate it more. Versus lowering your amount of money that they have to pay you because they're qualified. To them, it's a cheap payment. You brought your value down to their standard versus you keep your standard here, but you helped them get into a better place. That's just my mentality.
Okay, gotcha. It's your deal.
Yeah, no, you're good.
It's your deal. I don't mean to push back. I just want to ask the questions that I know I have. If I'm watching this video, these are the questions I would have.
So I talked to another individual where they have a 20 unit and they were asking me more recently. I ran into them at Home Depot and they were having trouble filling them too. People were just leaving, especially with all the stuff that's going on with immigration and everything like that. They were at 900, 975. They were similar to us. They've brought them all the way down to 550 and they still can't fill them.
Oh my gosh.
So to me, I'm like, I don't think that's the smart play.
Yeah.
So we're going to go into 18. Let me grab the keys.
Okay.
Now, the ones upstairs, we've already gutted them. Like, we've already pulled everything out. I wouldn't say gut, but We've already removed all the trash and everything. Excuse us. So we're currently working on this one. So these are the final 3. I'll let you go in first.
So this is a before picture.
This is a before.
So they've been gutted. Well, almost.
This one was a hoarder. Like, this unit was one of the vacant units when we took possession. And there's nothing but boxes all the way to the ceilings. And so getting this one cleaned out was a big ordeal. And so we couldn't salvage anything. So we just pulled up the floor and like, all right, we're just going to start fresh.
You're going to pull these cabinets out and everything?
Yeah, we can't reuse these.
Yeah.
Not even if I wanted to. Yeah, so
are they all they all look the same?
Yep, they're all the same. They all are just flip-flopped.
Did you give any thought to trying to combine some units?
It was a thought, but the value for a 1 or 2 bedroom at the time wasn't there. Like we could get maybe an extra $100 or $200. And so our thought was like, we're going to lose more money taking off more units.
Right.
Yeah, that's how.
So somebody lived like this?
At one point, yeah.
Gosh. That's wild to me.
Yeah, like you still see some remnants of all the Coke bottles of the hoarder situation. Now in 18 we're about to use, I actually have a video I took of when we evicted that individual, and that was the most disgusting unit I have ever walked in.
Is that when we're going into that one right
now?
That
one we're going into that one.
All right, let's go look at that one.
Yeah, that one was out, and if y'all follow me on Instagram or whatever, you can go back and see that.
We'll link that up.
Yeah, we'll see that view, because that one was woof.
Okay, here we are. He said 18. Here we go. You guys are probably lucky we can't capture the smell on video.
Yeah, it still smells like I remember.
So, Evan, you bought these when?
We bought them in 22.
22?
Yep.
So we've had them for 3 years. So tell me, why is it, so you had to get people out. You had to go and renovate basically all of them at some point.
Yes.
So you've renovated, how many are renovated and rented today? Like renovated?
It would be 12.
So you've renovated and rented out 12 of them.
Right.
And now you got 12 to go. Okay,
right.
Gotcha.
So these are the last 3. We're working on 4, right? Currently. And so all the other ones have renovated. The only 2 units that we have not renovated is the barbershop and unit 5. So
because they're people, there's tenants, businesses in
businesses that have been there. So when we're done with this, which should be in the next month or so, we'll have renovated 22 units.
Gotcha.
Total.
In almost 3 years.
Right.
Okay. That's just how long it took to get people out. That's probably the main thing.
It took a while to get people out.
Because you're not renewing leases, but you're honoring the lease that they currently had. Right. Because they were probably paying.
They were paying, yeah. Some were paying, some weren't. We got the bad ones out that were causing issues. This dude was causing issues. He's literally walking around with a machete in our courtyard trying to summon his dead girlfriend.
What?
Yeah. Yes. So the initially we were going to do, all of these were going to be Airbnbs. But with the Airbnb boom, it was already saturated. And so we didn't, I didn't think it was best for us to go into a saturated market doing everything Airbnb. So then we started, because the first 6 or 8 that we did tile in the bathrooms, we did tile showers, and we were really trying to make it upscale nice for the Airbnb guests. But then as we started doing it, I was like, we need to have some midterm, we need to have some long term stuff like that. I can show you a fully furnished unit as well.
What does a Airbnb rent for a night, like consistently, safely?
In our market, for what we have, anywhere from $50 to $60 a night.
Okay.
Low side 40, high side 75.
Okay.
But the cleaning fee is like $90 or $120. I think we have a 2-day minimum. So they're paying more for the cleaning fee, or just about, if they get it on the low end versus the high end. So, but we have different types of turnover. Some people are here for 2 or 3 nights, but most of the times what I'm seeing is like 4 or 5 nights, 3 nights, upwards to a month. We've had some tenants, short-term guests, to stay in a unit for 6 weeks, 6-8 weeks.
Now, can they do a midterm? Can they do a month on Airbnb? And do they?
No, I don't know if they could. Yes, they could book a month on Airbnb if the time slots allow.
Right. What do you rent it for if it was a monthly?
$1,500 a month.
Wow.
Yeah. $1,500 leased.
Wow.
Fully furnished. Yeah.
Okay.
And we actually had that's our best profit.
Yeah.
Is the midterms. Lower maintenance.
Yeah, for sure.
It's higher than the long terms. But you don't have the turnover like the short terms.
Right.
So we were netting like $1,200-$1,300. And we just didn't have all the other fees and all the stuff that Airbnb and all the other places charge. So, but our STRs, we net about the same we net with the long term. And so, but there's just a higher cost of management, higher turnover rate. And so it's like, if we're going to net the same, we need to be more stabilized versus have more volatility.
For sure.
And then if we want to make money, we'll just convert the STRs into MTRs, and then we'll just profit off of those, more than what we were expecting.
What's the demand? The demand is for more of what?
Right now, the demand has been for like midterm rentals and short-term rentals. That's been the demand. If we were having this conversation a year ago, I would literally have people drive in my parking lot looking for a place to rent. It's like, at that time, I didn't have any vacancies.
What's changed, do you think, in a year?
Either the economy, jobs. In our market, there's probably like 2,000 or 3,000 units that are apartments online. And so a lot of the B-class people are going to A-class apartments. A lot of the C-class tenants are going to B-class. And so it's left this gap between all asset classes in apartment complexes. But you could get this same space over in mid-city or campus, in that Campus A5 area, and you're going to be paying like $1,500 a month for unfurnished unit. If you go to Enterprise Way, those $1,700, $1,800, $2,000, like you're going to be paying a lot. So we want to be in the more affordable range.
Wow. And
so, but I think people are just getting pushed up, or they see value in the newness and being in like the community, because we don't have that many amenities, and so all these other places have a lot more amenities.
Right.
So it could be that as well. So it could be a couple of different factors.
Gotcha.
But at least that's what I think.
Gotcha. You gonna show me one more?
We'll show one more, yeah.
All right.
And that'll be the one we midterm. Make sure these are locked up. Lock this guy up. Yeah, but we still got to do exterior work, right? We plan to redo this deck. We're going to put a roof on it here soon, and then we're going to paint the exterior of the building. But the main goal has been getting the units fixed.
For sure.
And leased in full before we start doing any exterior, because we still got to do the parking lot. So we're still not done here, but it's a work in progress.
Gotcha.
So this one is the Airbnb. You can probably peek in there.
Okay.
You probably can't see nothing in there. I'll show you one down here.
Okay. So this is a furnished unit.
Yes.
Now I kind of see the vision, I guess.
Well, with you nothing in there, yeah, it's kind of hard to see.
It's hard to see because it's the angle, I guess. Everything's at. But this is this is a great hotel room. It's really what it is, right?
Ultimately, yeah, it's like an efficiency type
But for
thing.
like $50 a month or $50 a night is pretty.
Yeah.
This is very well done.
Yeah, as you can see the differences. So we did the same LVP here, but we would tile in the bathroom, tile in the shower. Just a nicer stay.
Yeah. So Evan, this is the last thing I want to ask you about.
Okay.
Try to get some light on you.
Yeah.
So in the very beginning of the video, you talked about the numbers a little bit, the syndication and thing. I want to kind of come back to that so I can fully understand what you're talking about.
Okay.
So you, from a syndication standpoint, you pulled money together and you purchased the property, and you also pulled money together for the rehab.
That's part of the syndication.
And so, right. So you pulled investors together under, and I don't fully understand syndications, but under some sort of
506B.
There you go. That's what I was looking for.
A fund.
So a fund. You pulled all that money together and you're doing this property. You're giving them returns on their money.
Yes.
Are they getting monthly returns right now?
They're not currently, not until the building is stabilized.
Okay. So it's been like 3 years, right? So is this what you projected? Is this what you told them? Is it taking a little bit longer than you thought?
It is taking a little bit longer than we thought, but I'm not the only general partner in this. And so there's 4 other partners that did this together. Mm-hmm. My main role has been rehab management, acquisition, and then since I'm here local, just managing the managers. Mm-hmm. So I have other general partners that managed raising the capital. They met with the investors, they set the expectations with them. So from our understanding, this is a 10-year hold. They signed into a 10-year hold. It's an opportunity zone. So the individuals that signed a PPM knew this was a long-term deal.
The 10-year mark, that's important for the opportunity zone.
Yes, it's very important because there's tax advantages for investing in an opportunity zone. Right. I don't know the full details on it, and I know they've changed the policy multiple times in the last several years that we've done this, but that's what the whole play is. And so what we're actually doing is we have a 70-30 split. So 70% of the equity is the limited partners' equity. 30%.
Which is the investors.
That's the investors. Okay. Ultimately, they're silent partners. Right. We retain 30% in the management company, 30% of the equity, and we do a 60-40 cash flow split of the net cash flow. So when the building is fully operational and cash flowing, they'll receive 60% of the cash flow after all expenses are paid, and we would retain 40%. Gotcha. So it is very lucrative, and we are also doing an 8% pref.
Right.
So we're going to have to catch them up for those years.
That's what I was going to ask next.
You're going to have to catch them up for those years that it wasn't cash flowing because it has taken a little bit longer. And we do have, I'll be honest, we do have some investors that want to be bought out, right? Because it's taken a little bit longer than they wanted, and they thought that they were going to start immediately cash flowing. They didn't understand the complexities of owning and managing an apartment complex. That's why they lent the money. Or they didn't lend. That's why they invested with us, right? But delays happen, contracting, scheduling. I want to be all negative Nancy, but dealing with the city, they've changed their process throughout the years. Getting business permitting, making sure that the short terms are actually operational and cash flowing. There's a lot of complexities in itself, other than it would just be so much simpler just to, we're just going to start writing you checks. But then if we just start writing you checks, you're going to diminish the value of your own asset, right? And so how can we make you payments right now and lose the asset, right? Because insurance has gone up. When we first bought the building, insurance was $8,000 a year. Then it went to 12. And then because we were doing short-term rentals, it went up to 29. So for the last 2 years, we've been paying $29,000 a year just in insurance to operate the building. That's another reason why we're moving away from short-term into long-term and MTR, is because we're trying to get our insurance costs down. Because as we started making cash flow and we thought that we could start issuing checks, well, our expenses went up. Also, yearly tax. When we bought the building, I want to say it was $5,000 a year for the property tax. Well, when they saw that we bought it for 1.25, like, oh, that's the value. even though that wasn't the true value because we bought it seller financing, and it's not making that, right? It's not making $300,000, $400,000 a year. It was making, when we bought it, $78,000 a year, $90,000 a year. And so the building wasn't worth that. And so then our taxes went up to 11, 12 grand a year. And so we've been paying that. And then just, talking with them to justify these cost increases, well, they're like, well, everything's going up. And so, we bought at a time where the numbers really, really were very lucrative with the current interest and taxes. Mm-hmm. But over the years, that stuff, the profit's been eaten up by holding costs just on those two things.
Yeah. Well, Evan, first, thank you for taking me through all that. And that's probably not an easy thing to share, but thank you for being honest, because I think it really does help people kind of understand, and it helps me understand more the 975 number. Yeah. Like, you need that number.
We definitely do. We need it for the value, but also to maintain the building. And luckily it's seller finance and not with a traditional bank.
Right.
Because if we were with a traditional bank, and the insurance went up, I'm not sure if you know this, but they want a CapEx reserve for insurance and taxes.
Yes.
And so if our insurance went up to $30,000 a year, they'd probably want to see $60,000, $80,000 in the account at all given time. And if we didn't have that, well, they could foreclose and take the asset. And then now we would lose the investor's funds. So it's really important to partner with individuals that know how to structure things correctly.
Yeah.
Yeah.
And then so remind me again, I know you said at the beginning of the video, but the seller held how much?
$1 million back.
And so you only came to the table with
$250,000 down.
Plus rehab costs.
Plus the rehab costs.
Yeah.
So, and he's at 4% interest. And every 5 years, which in 2 years, we'll get to negotiate.
I was about to say, is it a balloon or he?
It is a balloon, but it's a 40-year note, but every 5 years.
40-year amortized. With a 5-year balloon, but he might.
No, it's interest only, but we have the note for 40 years.
Got you.
But every 5 years, we have the option to renegotiate either principal buy down, refinance options.
So you're only paying interest.
We're only paying interest right now.
That's good.
Yeah, it's good for our cash flow perspective, because I think our payment's like $33 a month.
Yeah.
But if we were to take that same $1.25 million loan to a bank right now at 7.5%, 8%, I mean, that payment's going to be $8-7 just for the principal and interest.
That's just for the principal and interest. That's not include any escrow.
Right. And so like on our best months, like we've netted, we've grossed like 15, 16K a month in this building. But on some of our low months, it's like 8 or 9, 10. So we have enough to build up a reserve in case something happens. And then the money goes to the expenses right now. So that kind of explains why the investors haven't received, a return yet.
Right. Well, man, that's a lot. So thank you for taking me through all that.
Yeah, no problem, man.
I definitely get it. But this is a great unit for sure. I mean, it just kind of reminds me of it's just like an extended stay kind of thing. Yeah. And it's done really well. And there's a market for it. There's a need for it. Now, 975 really surprises me.
Does it?
Oh, yeah.
Yeah.
Yeah, that really surprises me. I thought 650, maybe 750.
Well, we are close to Mid-City.
And this is what I don't know. I don't know about the market. I don't know about the area.
So we're, like I said, we're close to Mid-City. We're close to Airport Road. It's like 10 minutes away from Crestwood Hospital. You're 15 minutes from downtown Huntsville. Yeah. It's a pretty centralized location, but they've been putting a lot of money in West Huntsville. Gotcha. And so we're in the path of progress.
Gotcha. Nice to be in the path of progress.
Exactly. Yeah.
Evan, thank you so much. Guys, I appreciate you. This video went way longer than I thought it was going to go. But thank you so much for taking me through the numbers. Yeah. Thank you for taking me on a tour of this awesome property.
No,
congratulations.
Thank you.
I know there's a lot of challenges ahead, but it looks like you guys are
we're
right in the ship.
Yeah, we're going through it.
Thanks, Evan.
Thank you.
All right.